Welcome to Trader Wall. In today's video, we're diving deep into the differences between two of the most popular trading markets, Forex and crypto. So let's break down the key features, risks, and opportunities of each market. Don't forget to hit the like button if you find this video helpful, and let's get started. Introduction to Forex and crypto. Forex, or the foreign exchange market, is the world's largest financial market where currencies are traded. Unlike traditional markets, which operate in physical locations, Forex is decentralized and consists of a global network of banks, financial institutions, and brokers facilitating currency exchange. The market is influenced by macroeconomic indicators, interest rates, and geopolitical events. Cryptocurrency, on the other hand, is a relatively new digital asset class built on blockchain technology. Unlike traditional currencies, cryptocurrencies are decentralized and operate on peer-to-peer networks. Some of the most popular digital currencies include Bitcoin, Ethereum, and Ripple. Crypto is known for its disruptive potential, powered by technology rather than central authorities, and has gained immense popularity due to the rise of decentralized finance, DeFi, and blockchain applications. Market structure and accessibility. In the Forex market, currency trading happens through centralized intermediaries such as banks and brokers. These entities connect buyers and sellers, allowing the trading of currency pairs like EUR/USD or GBP/JPY. The market operates 24 hours a day, 5 days a week, following the business hours of major financial centers around the world, like New York, London, and Tokyo. Forex also allows high liquidity due to its massive daily trading volume, and traders can execute orders quickly and with minimal slippage. The cryptocurrency market is different in that it is decentralized and operates on blockchain networks, which are essentially distributed ledgers. Cryptocurrency exchanges like Binance, Coinbase, and Kraken allow users to trade digital currencies, but they don't operate in the same way as traditional exchanges. In the crypto market, peer-to-peer transactions are validated through mining or staking mechanisms, providing transparency and security. These exchanges are open 24/7, unlike Forex, allowing traders to buy, sell, and hold crypto at any time. Volatility and risk. One of the key differences between Forex and crypto is the level of volatility and risk associated with each market. Forex trading tends to be less volatile compared to cryptocurrency. While currency pairs like EUR/USD or USD/JPY can experience fluctuations due to interest rate changes, government policies, or economic reports, these movements tend to be moderate. Forex traders rely on fundamental analysis, such as analyzing economic indicators like GDP or unemployment rates, monetary policy, and central bank statements to predict currency movements. Crypto, however, is notoriously volatile. Prices can change dramatically within minutes or hours. For instance, Bitcoin's price may jump by 10 to 115% in a single day, driven by factors such as regulatory news, market sentiment, or tech developments like the introduction of new upgrades or forks. Traders often use technical analysis to make informed decisions in this highly unpredictable market. But due to the rapid pace and speculative nature, crypto markets carry a higher risk of large losses or gains. Market liquidity and size. The Forex market is the largest and most liquid market in the world, with more than 6 trillion traded daily. Because of this, there's generally little to no slippage when executing trades in major pairs. Liquidity is key in Forex as it ensures smooth trade execution even for large transactions. High liquidity also lowers the cost of trading since there is less price deviation between the buying and selling prices. In comparison, the cryptocurrency market, while growing, is much smaller in terms of market capitalization and daily trading volume. As of now, the total market cap of all cryptocurrencies is just under $1 trillion, with Bitcoin accounting for the majority of that figure. Lower liquidity in crypto markets can lead to larger price swings, especially with less popular coins or tokens. For example, trading a small-cap altcoin can result in slippage, where the execution price is significantly different from the market price at the time of the trade. Regulation and security. Forex is highly regulated, with government agencies such as the US CFTC, UK FCA, and other financial regulatory bodies overseeing the market. These organizations enforce rules to protect traders, ensure market integrity, and prevent fraud. Brokers in regulated jurisdictions must follow strict guidelines, including capital adequacy and reporting requirements, and they're often required to provide transparency in their pricing and execution practices. Cryptocurrency, on the other hand, operates in a much less regulated environment. While some countries have begun to introduce regulations around crypto, many jurisdictions still lack comprehensive frameworks for oversight. The lack of regulation in crypto can lead to risks, such as scams, fraud, and market manipulation. However, blockchain technology provides a high level of security for transactions. The decentralized nature of crypto means that it is harder to hack or alter transactions, but exchanges and wallets are still vulnerable to attacks, as evidenced by incidents where exchanges have been hacked. Technology and trading platforms. Forex trading relies on traditional trading platforms like MetaTrader 4.5, which provide access to charts, indicators, and automated trading tools such as expert advisors. These platforms allow traders to analyze the market using advanced technical analysis and execute trades with ease. Crypto traders, on the other hand, rely on exchanges like Binance, Kraken, Coinbase, and decentralized platforms such as Uniswap and PancakeSwap. These platforms typically offer various trading tools and interfaces tailored for crypto, with features like wallet integration, staking, and yield farming. Risk management and tools. Both Forex and crypto traders use similar risk management techniques, such as stop-loss orders, take-profit orders, and position sizing, to limit potential losses and lock in profits. However, due to the inherent volatility of crypto, risk management becomes even more crucial in the crypto market. In the Forex market, risk management strategies tend to be a bit more straightforward due to the market's lower volatility. Traders often use position sizing to ensure they don't risk more than a predetermined percentage of their capital on a single trade. Diversification and portfolio building. Forex offers limited diversification opportunities within the realm of currency pairs. Traders can diversify by trading different currency pairs or by using different timeframes to reduce risk. However, the underlying assets in Forex are still fiat currencies, which are affected by similar macroeconomic factors. Crypto offers much more diversification, as traders can choose from a wide variety of digital assets, including Bitcoin, Ethereum, and altcoins, with different use cases, DeFi tokens, NFTs, privacy coins, etc. This diversification provides an exciting opportunity for investors, but it also means more complex risk management and technical analysis are needed. Future outlook. The future of Forex and crypto markets looks promising, but both will likely evolve in different ways. Forex is expected to remain the dominant global market for currency exchange, and with the rise of digital currencies backed by central banks, central bank digital currencies or CBDCs, Forex traders may have new instruments to trade. The integration of technology in Forex trading, such as algorithmic trading and AI-driven insights, will continue to improve trading strategies and market efficiency. The future of crypto, however, is more uncertain. While the potential for massive growth and adoption exists, the market still faces hurdles such as regulatory challenges, security issues, and scalability concerns. However, as blockchain technology matures and more use cases for digital currencies emerge, such as NFTs and smart contracts, crypto could become an even more integral part of the global financial ecosystem. Conclusion. In conclusion, both Forex and cryptocurrency markets offer unique opportunities and challenges. Forex is a well-established market with a strong infrastructure, lower volatility, and a more predictable nature. It's ideal for traders who prefer stability, deep liquidity, and a market driven by macroeconomic fundamentals. Cryptocurrency, on the other hand, is an exciting and rapidly evolving market full of potential, albeit with higher risks due to its volatility and speculative nature. As a trader, understanding these differences is essential for crafting a trading strategy that aligns with your risk tolerance, investment goals, and market outlook, Whether you choose to trade Forex, crypto, or both, always remember that success in trading comes from education, preparation, and effective risk management. Thanks for watching today's video on the differences between Forex and crypto. We hope this helped clarify how each market works and the unique opportunities they offer. If you're new to the channel, make sure to subscribe for more trading insights and tips. And if you have any questions or thoughts, drop them in the comments below. I'd love to hear from you. Until next time, happy trading, and remember, knowledge is key to success in any market. See you in the next video.